Welcome back to Talk Tickers.
Good to be here.
This is the deep dive where we strip away the noise, we ignore the press release fluff, and we just get straight into the machinery of the market.
Exactly.
We are not here to read you the headlines you already saw on your terminal. We are here to understand the mechanics of the trade. Today, we are popping the hood on a company that is essentially a proxy for global migration.
A proxy for the working class economy, really.
Right. And for the movement of money across borders in general, we're talking about Western Union. The ticker is WU. The date is Wednesday, February 25th, 2026.
And if you were watching the tape this morning, you know it was a volatile one.
Oh, absolutely.
This is a classic battleground stock right now. It feels like the market is trying to decide if this company is a dinosaur or a sleeping giant.
Yeah. And today, the dinosaur narrative was definitely winning early on. Let's just set the stage with the market context, because the price action tells you half the story before we even look at the numbers.
Oh.
So we were looking at the Q4 2025 earnings print. The stock closed today around $9.27.
Down about 1.8%.
Right. But that closing price hides a lot of drama. It masks what was actually a pretty violent session for a stock that usually trades like a utility.
It really does. If you were up early watching the pre-market, you saw it indicated down nearly 2% right out of the gate.
Yeah.
Then the bell rings, the algorithm reading the headline revenue number kicks in, and at one point intraday, the floor just fell out.
It dropped as much as 6%.
Yeah. For a stock like Western Union, a 6% move is massive. That is a repricing event.
A 6% drop for a low beta stock like that implies a lot of people rushed for the exit simultaneously.
But then almost as quickly, it clawed its way back.
To close down just under 2%, like we said. And the volume was heavy too. We are talking 2.3 times the average daily volume.
So people were trading this actively. There was a real difference of opinion happening on the desk today.
That volume tells me that while the initial reaction was, sell the news, there were buyers stepping in at those lows.
Institutional buyers. The street is clearly divided. And the division comes down to what we often call the two-handed story.
Right, the two hands.
On the one hand, you have profitability and cost control, the operational discipline. On the other hand, you have a top-line revenue that is leaking.
Exactly. The headline sentiment check is just pure skepticism right now. Despite an earnings beat, which we will get into, the revenue miss is the headline story.
Because you can optimize your margins all day long. You can cut costs, you can digitize, but if the actual amount of money coming in the door is shrinking, the market's going to punish you.
You cannot shrink your way to a higher valuation forever.
That is the fundamental rule of Wall Street. Eventually, you run out of costs to cut.
All right, so our mission today for this deep dive is to figure out, is this a value trap trading at a low multiple that is going to grind your capital to dust? Or is this a turnaround story that is just about to corner the market on digital wallets?
That is the billion-dollar question.
So here's our roadmap for the show. First, we're going to do a rapid-fire snapshot of the headline financials.
The good, the bad, and the ugly.
Then we're going to dissect that two-handed story we just mentioned, the war between digital growth and legacy retail decay.
We also need to talk about the beyond strategy. Management is betting the house on diversifying beyond simple remittance, and we have to talk about the Intermex acquisition.
Because that is the lifeboat they're swimming toward right now.
Exactly.
And finally, we will wrap up with the guidance for 2026 and our favorite segment, the Not Financial Advice Wild Trade Pitch, where we try to find an edge in this mess. Let's get into the numbers. What did the P&L actually look like?
Let's start with the bottom line, because that is where the good news was. Adjusted earnings per share, or EPS, came in at 45 cents. The street was looking for 43 cents, so that is a beat. They came in about 4.6% ahead of expectations.
So they made more profit per share than the analysts thought. That sounds good on the surface, but we always have to be careful with adjusted numbers. What about the GAAP number?
Right, the GAAP EPS was 36 cents. Now, you need to be careful comparing that to the prior year. The prior year was $1.13.
Whoa, $1.13 down to 36 cents.
Yeah, but that prior year was heavily distorted by a massive tax benefit. It was a one-time windfall. So the drop in GAAP EPS looks scary on paper if you just look at the percentage change, but it is mostly noise.
Oh, okay.
The adjusted 45 cents is really the number to focus on for operational health.
Right. So operationally, they are making money. But here is the pain point. Here's why the stock took a nosedive this morning. The revenue.
Revenue came in at a flat $1.0 billion. The consensus on the street was looking for somewhere between 1.04 and 1.05 billion.
So that is a $30 to $40 million miss.
In a business this mature, missing the top line by that much is a huge red flag. Year-over-year revenue is down 5%.
Down 5%. That is the number that matters today. You beat on earnings because you controlled costs.
Yeah.
Maybe you bought back some shares, but the business itself generated 5% less cash from customers than it did a year ago.
That is a shrinking pie.
Precisely. And management did highlight their capital returns to try and soften the blow.
Oh, of course. They always do.
They returned over $500 million to shareholders in 2025 through dividends and buybacks. They approved a quarterly dividend of 23.5 cents per share.
So they are paying you to wait. But the market is looking at that revenue line and asking, how long can you pay us if the business keeps getting smaller?
It feels a bit like hush money, doesn't it?
Yeah.
Like, here is a dividend, please don't look at the revenue chart.
Yeah, pretty much.
So the immediate takeaway here is a divergence. Management is executing on margins. I mean, operating margin was up to 20%, which is genuinely impressive.
Very impressive for this environment.
But the market is punishing the lack of organic top-line growth.
It creates what we call a confidence gap. Management says, look how efficient we are. The market says, show us you can actually grow. Efficiency is great, but growth drives multiples.
Let's dig into why they aren't growing. This brings us to section 1 of our deep dive, the core problem. And the core problem has a name, retail and the Americas.
This has been the story for a while, hasn't it?
This has been the anchor dragging the ship for a few years now. If we look at the consumer money transfer segment, or CMT revenue, was down 7% reported and 9% adjusted.
And transactions were down 2%.
Okay, let's unpack that. Revenue down 9% adjusted, but transactions only down 2%. That implies something really interesting about the pricing or the mix, right?
They are losing revenue much faster than they are losing customers.
Exactly. Why is that happening?
CFO Matt Cagrin talked about this quote-unquote new normal. What they are seeing is fewer transactions, but a higher principal per transaction.
People are sending money less frequently, but when they do send it, they're sending larger amounts.
Right, which sounds okay in theory. I mean, it's less work for the same amount of money moved.
But if the revenue take rate is dropping, that is an issue. Why does higher principal actually hurt them?
Because the fee structure isn't linear. If you send $100, they might charge $5. If you send $500, they might charge $10.
Ah, I see. You sent 5 times the money, but they only made twice the fee.
Exactly. Plus, in competitive corridors, the margins on larger amounts get squeezed even tighter.
Got it. Now let's talk about the geography. The Americas is the headache here.
Specifically, the U.S. outbound market. Retail in the Americas remains the primary drag. The U.S. to Mexico corridor is the big one.
It is the largest remittance corridor in the world, practically.
It improved quarter over quarter, so Q4 was better than Q3, but it is still negative year over year.
Management mentioned the Bank of Mexico data on the call. They said there was a slight positive turn in principal growth recently. Is that a green shoot? Are we seeing a real turnaround, or is this management just finding the one nice statistic in a sea of red?
You really have to read the fine print on that data. Yes, principal growth ticked positive. However, we have to ask ourselves why that happened. There is a very strong possibility that this was a pull forward.
They pull forward, meaning people rush to send money before something happened.
Exactly. And that something is the U.S. remittance tax.
Yes, the policy impact. This has been looming over the sector. This tax went into effect on January 1st, 2026. This is a tax on money transfers leaving the U.S.
Correct. Now, management on the call claimed no material impact in the first 6 weeks of 2026. They said the systems handled it flawlessly, compliance was good.
But they admitted it is a headwind for the retail environment.
Let's role play the consumer here for a second. If you are a worker sending money back home to Mexico to support your family, and you know a tax is starting January 1st that is going to take a percentage of your hard-earned cash, what do you do in December?
You send everything you can.
You empty the savings account, you borrow from a friend, you front load that transfer to beat the tax.
Exactly. You drain the bank account in December. So that improvement in Q4 might just be people panicking and front loading their transfers.
If that is the case, Q1 2026, the quarter we are in right now, could see a nasty air pocket where volume drops off a cliff because everyone already sent their money early.
That is a massive risk factor. It completely questions the stability they are touting. If the Q4 bump was artificial, the Q1 drop is going to be very real.
And management is trying to downplay it, saying no material impact, but common sense economics tells you that when you tax something, you get less of it.
especially when the customer base is highly price sensitive. We aren't talking about massive corporate wires here. We are talking about people sending $200 for groceries.
And this tax hits the retail customer the absolute hardest. The digital savvy customer might find ways around it or use crypto or different banking rails. The person walking into a bodega with cash to send money, they just get hit with the fee.
It makes the retail product less competitive and way more expensive compared to informal networks.
Which segues perfectly into the other side of the story. If retail is the anchor, digital is supposed to be the sail. Let's talk about Section 2, the digital pivot.
But looking at these numbers, I'm calling this growth with an asterisk.
The asterisk is very heavy here. Let's look at branded digital performance. Revenue was up 7% reported, 6% adjusted. That is growth. It is positive.
Yeah.
But look at the transactions. Transactions grew 13%. So you have transaction volume growing at double digits, 13%, but revenue only growing at mid-single digits, 6%.
That is a massive spread.
It is a huge gap.
That means the value of every new digital transaction is significantly lower than the existing ones. Why are they doing so much more work for proportionally less money?
It is the source of the growth. A huge chunk of this transaction growth is coming from new partnerships in the Middle East. These are account-to-account transactions.
Account to account? Meaning not a guy walking in with cash, but a bank transfer or a digital wallet transfer.
Exactly. And crucially, Western Union is partnering with local super apps or telecom providers in the Middle East. They are essentially providing the plumbing for these other apps.
They are the white label rail underneath.
The problem is the revenue per transaction, or RPT, on these deals is significantly lower.
So they are getting volume. They can go to Wall Street and say, look, our transaction count is up, but it is lower quality revenue compared to the legacy business where they charged a high fee for a cash transfer.
They are becoming a utility provider rather than a premium service.
Precisely. It is a trade-off. They are capturing market share and staying relevant in a digital world, but they are diluting their own yield. They are trading high-margin dollars for low-margin pennies, hoping to make it up on sheer volume.
It is the classic commoditization of the layer problem.
That is exactly the commoditization trap. But is there a bright spot where the margins are actually holding up? Is there any part of this digital story that is actually high value?
There is consumer services. This was actually the star of the show, even though it is a smaller piece of the pie right now. Revenue was up 15% reported and a massive 26% adjusted.
26% growth is nothing to sneeze at. That is tech stock level growth. What is driving that?
Two main things. First, travel money. This includes their Euro change business. Management noted this is approaching $150 million in revenue. A few years ago, this was nearly zero.
That is impressive scaling. That suggests they have found actual product market fit there.
It is, and bill pay was also strong. The strategic implication here is that management is successfully diversifying. They're proving they can be more than just the remittance company.
They are becoming a broader financial services provider. They're helping people travel, pay bills, manage currency.
But the question remains, is consumer services growing fast enough to offset the bleeding from the retail giant? $150 million is great, but the main business is billions.
Currently, no. That is why overall revenue is down 5%. The life raft is inflating, it looks great, but the Titanic is still taking on water faster than the raft can inflate.
Which brings us to the big fix. If you can't grow organic revenue fast enough, what do?
You buy it.
Yeah.
Section 3, the Beyond strategy and the Intermex acquisition.
This is the centerpiece of their 2026 narrative. They are acquiring Intermex. The update from the call is that they expect this to close in Q2 2026, which is actually a bit earlier than some people feared.
So Intermex gets folded in. This is a massive play for the Americas, right? Intermex is huge in the U.S. to Latin America corridor.
It is a North America-centric play. It is explicitly designed to patch that hole we discussed in Section 1. They are buying density and growth in the corridor that is hurting them the most.
Intermex has been eating their lunch in certain neighborhoods, so Western Union decided to just buy the lunchbox.
It feels a bit like a defensive merger. Like, we are losing share in U.S. to Mexico, so let's buy the guy who is winning. It reminds me of big banks buying fintechs just to stop the bleeding.
There is certainly an element of that, but it is also about synergy. Management is embedding Intermex into their full-year guidance. They believe that by combining Western Union's global rail with Intermex's local retail density, they can squeeze out costs and maybe stabilize pricing.
But here is the skeptic's view. Is this organic growth?
No. It is buying revenue.
The market generally assigns a lower multiple to purchased growth than to organic growth. If you strip out Intermex, the company is shrinking.
Correct. The market wants proof that the core Western Union brand still has a pulse. If you strip out Intermex, the organic growth is looking flattish at best.
However, there was a counter-narrative on the retail side that I found fascinating on this call. It wasn't all doom and gloom.
You are talking about the winbacks.
Yes. The narrative that retail is dead might actually be premature. It is consolidating. Western Union announced some massive wins. Deutsche Post, the German postal service, they lost them years ago.
That was a huge blow to their European footprint when that happened.
Right. Now, they are back and they are exclusive.
That is a very big deal. Deutsche Post is everywhere in Germany. If you live in Germany, that is your local hub.
Exactly. And Canada Post, a new exclusive 5-year deal. That is a competitive takeaway. They stole that from someone else.
And Kroger, the grocery giant in the U.S., back to exclusive status. And Vallarta Markets in California, which is huge for that Latino demographic we talked about earlier.
So what does this tell us? Why are these big players coming back to Western Union after trying other options?
It sounds like the smaller players just can't keep up with the compliance and tech costs. The regulatory environment for moving money is getting stricter every single year.
Anti-money laundering, KYC, cybersecurity.
Exactly. It costs an absolute fortune to maintain those systems. Management projects at least $100 million in incremental retail revenue per year from these wins once they ramp up.
It proves that Western Union's partner OS, their tech stack for agents, is actually working. They're using their sheer scale to squeeze out the smaller competitors.
They are positioning themselves to be the last man standing in retail remittance.
Being the last man standing in a shrinking market can be very profitable. Just ask the tobacco companies. But you have to manage the decline perfectly. You have to be the most efficient player in the game.
Right. And while they manage the decline of cash, they are trying to build the future. That leads us to the digital ecosystem and, dare I say it, crypto.
Section 4, the wallet strategy. This isn't just about sending money anymore. It is about holding money.
This is the ecosystem play. If I send money to you, Western Union doesn't want you to cash it out and walk away. They want you to keep it in a Western Union digital wallet.
They want to be your bank account, effectively.
They mentioned the Vigo Money wallet in the U.S. 30,000 customers onboarded. That sounds incredibly small for a company this size. 30,000 is a rounding error.
It is small, but look at the acquisition cost. It is incredibly low. They are redirecting payout customers.
So someone comes to pick up cash and they say, hey, put this in the app instead.
It is efficient. But the real success stories are in South America.
Brazil and Argentina. Those are very different markets.
Brazil's wallet is redirecting 5% of inbound transfers. Argentina is redirecting 17%. That is a significant number.
In Argentina, where inflation is just a nightmare, people want to keep money in a stable ecosystem.
And why does this matter for the stock? Why should an investor care if the money stays in the app?
Retention. If the money stays in the ecosystem, Western Union makes money when you spend it, when you pay a bill, or when you send it again. It stops the churn of cash out.
It increases the lifetime value of the customer astronomically.
And speaking of holding money in unstable economies, let's talk about their digital assets, crypto. They successfully minted their first US dollar payment token, USDP.
Now, usually when a legacy company talks crypto, I just roll my eyes. Is this just a press release stunt?
This is where the strategy actually gets interesting. They aren't just speculating on Bitcoin. This is an efficiency play. They are piloting moving funds between their treasury and their agent wallets using this token.
So instead of using this slow, expensive correspondent banking network, SWIFT and all that, they just zap tokens on a blockchain to settle with an agent in, say, the Philippines.
Exactly. Think about the capital efficiency there. Right now, they have to pre-fund accounts all over the world. Millions of dollars sitting idle just in case someone picks up cash.
If they can settle instantly with a token, they can free up all that capital. It shortens settlement windows. It reduces fees.
If they can pull this off at scale, it fundamentally lowers their cost of goods sold.
So it is a back-end improvement, but they teased a consumer product too, the stable card.
Launching with Visa and Rain in 12-plus countries. This allows consumers in high-inflation regions to hold U.S.-denominated assets.
If you were in a country where the currency devalues 50% in a year, holding a USDP token on a Visa card is an absolute lifeline.
That is a real utility-driven use case for crypto. It is not about speculation. It is about wealth preservation for their customers.
It is, and it positions them as a bridge between the old financial world and the new one. It gives them a product that a local bank in a hyperinflationary country literally cannot offer.
But let's zoom out. All of this innovation, all these acquisitions, what does it mean for the investor right now? Let's look at the FY 2026 guidance.
The outlook is, well, it's constructive, but with massive caveats. Adjusted revenue is guided for +6% to +9% growth.
Well, wait, +6 to 9%. We just spent 20 minutes talking about how revenue is shrinking. How do they get to +9%?
That is the Interrex effect. That guidance is inclusive of the acquisition. They are baking in the purchased revenue.
If you strip out Intermex, the CFO admitted organic growth is likely flattish.
So the growth is bought. Got it. That confirms the thesis that the core engine is stalled. What about earnings?
Adjusted EPS guided to $1.75 to $1.85. GAAP EPS lower at $1.50 to $1.60.
$1.85 at the top end. If the stock is at $9.27, that is a PE ratio of what, like 5?
It is incredibly cheap on a multiple basis. That is exactly why value investors keep sniffing around this thing. They see a 5x PE and a solid dividend, and they think it is a total steal.
But there is a headwind we haven't touched on yet, interest rates.
The debt refinance.
Western Union has a lot of debt maturing. They have notes that were locked in years ago at around 1.35%.
That is basically free money.
They have to refinance that debt in this current market environment. Even with rates coming down a bit, they're looking at paying significantly more interest.
So they're swapping 1.35% debt for what, 5% or 6% debt? That is a massive jump in interest expense.
Exactly. That eats directly into EPS. It is a non-operational headwind, but it is real cash going out the door.
So the confidence gap remains. The guidance looks okay on the surface, but investors know the growth is purchased and the debt is getting much more expensive.
They are waiting for the synergy proof. Management referenced a 10-cent accretion target from the Intermex deal, basically adding 10 cents to earnings per share.
But that is really a 2027 story, right?
Exactly. 2026 is the transition year. It is the year of integration, friction, and taxes. 2027 is the show me the money year.
And investors are impatient. They do not want to wait 18 months to see if the merger actually worked.
Let's talk about the macro environment briefly before we get to our trade ideas. Migration patterns. The CEO mentioned this. It is not just U.S. to Mexico anymore. It is highly dynamic.
It is volatile. Look at elections in Chile. Look at leadership changes in Venezuela. These political events turn migration flows on and off like a faucet.
The old days of predictable, steady growth, where you could just model 3% growth every single year, those days are gone. It is a dynamic environment now.
Global remittance is seeing faster digital adoption, but cash remains sticky in specific corridors. It seems like a very fragmented map.
And that fragmentation heavily favors the biggest player. Management's argument is simple. Scale is the only defense.
Compliance costs are skyrocketing. Tech costs are skyrocketing.
They are betting that only a few players can survive this environment. They want to be the last man standing who absorbs the volume from all the failed fintechs and smaller regional players.
It is a bold bet. We will survive because we are big. History has mixed results on that strategy. Blockbuster was big, Kodak was big.
But Deutsche Post coming back suggests maybe being big does matter in this specific industry because of the regulatory moat.
Indeed. It is a race between their decline and their pivot.
All right. We have analyzed the numbers, we have dissected the strategy. Now it is time to put our money where our mouth is, or rather pretend to.
It is time for the not financial advice segment.
Disclaimer time. We are not financial advisors. This is purely for entertainment. Do not trade based on two voices in your headphones. We are just role-playing hedge fund managers here. If you lose money, do not email us.
Okay, Mr. Hedge Fund Manager. The stock is beat up. It is sitting at $9.27. What is the play?
I have a pitch for the investment committee. I call this the remittance tax arb, or maybe the synergy squeeze.
I am listening. Is this a long or a short?
It is a short-term short with a specific catalyst. Here is the thesis. The market is pricing in way too much optimism on the Intermex integration in Q2. They think the deal closes, revenue pops, and everything is great. But they're wildly underpricing the lag effect of the U.S. remittance tax. Remember what we said about Q4 being a pull forward?
Right. Everyone sent their money in December to beat the tax.
That means Q1, the quarter we are in now, which they will report in May, is going to be ugly. The volume will not be there. And the Intermex deal might be incredibly messy in the first few months of integration. Integrations are never smooth.
So the trade is?
Short Western Union significantly into the Q2 Intermex close. You bet that the integration friction and the full realization of the tax headwinds in the Q1 report will cause a massive guidance cut.
You write it down to maybe $8 or $7.50 when the panic sets in.
That is ruthless. I love it. Short the hope cover on the reality. Do you have a hedge? You can't just go naked short on a company paying a fat dividend.
You absolutely have to hedge. I would go long the pick and shovel plays in digital wallets, or find a competitor with less U.S. outbound retail exposure.
Maybe a pure play digital remitter if you can find a public one, or a bank with strong cross-border exposure.
You want to be long the flow of money, but short the U.S. retail friction.
Okay, that is the rational bear case. I have an alternative pitch. It is a bit outrageous.
Let's hear it.
I call this the stable arb play. We talked about the USDP token launch and the stable card. The market currently assigns zero value to Western Union as a crypto play. They think of it as a dinosaur.
Which is fair, usually.
But midway through this year, they are going to publicly launch this token. There will be press releases. There will be headlines that say, Western Union launches global stablecoin network.
And you think the algos will pick that up?
I think we could see a temporary crypto valuation halo. You buy long-dated calls on WU specifically targeting the press release date of the public token launch mid-year.
You are purely betting on a narrative shift. You want to capture the AI crypto buzzword multiple expansion.
So you buy the calls, wait for the press release, watch the stock pop 10% because some retail traders get excited about WU crypto, and then
you dump it immediately. You do not hold this. This is a momentum trade on a value stock. It is dangerous, it is stupid, but it might just work.
That is incredibly speculative. I stick with my short thesis on the tax drag, but I admire the creativity. It is the kind of trade that works once and then blows up in your face.
That is why we make a good team. You bring the gloom, I bring the boom.
And hopefully you, the listener, bring your own due diligence.
Exactly. So let's wrap this up. Recap for the people driving home.
Western Union beat on earnings, but missed heavily on revenue. The stock was punished for lack of organic growth.
Intermex is the lifeboat, but integration risks loom large. Digital is growing, but lower margin.
And the final thought is Western Union a value trap trading at a low multiple, or a turnaround story about to monetize a massive user base via wallets.
The Q4 print suggests the jury is still out, and frankly, the market voted no today.
They are executing well on what they can control costs, but they are fighting a tide that is moving against them on the top line.
Until that revenue number turns positive organically, this ceiling is going to be very hard to break.
Don't catch a falling knife, folks. Watch the Q1 print carefully for that tax impact.
Thanks for listening to Talk Tickers. We will see you on the next print.